Welcome everyone. Thank you very much for joining us this morning for our Westpac Smarts webinar. The Queenstown Chamber is proud to partner with Westpac to bring you a seminar series that provides you access to a variety of speakers across different industries and specialisations. Today, I'm very pleased to introduce our speaker, Satish Ranchod. He is the Senior Economist at Westpac, and he will talk to us about the state of our economy as we move through 2022 and beyond. Satish joined Westpac's economics team as a Senior Economist in October 2014, and his work focuses on inflation and developments in New Zealand's household sector. Prior to joining Westpac, he was an advisor at the Reserve Bank of New Zealand, and much of his career has focused on analysing and forecasting the effects on the New Zealand economy, with a particular focus on inflation. He's also spent time as an economic researcher, leading the RBNZ's analysis of the economic effects of the Canterbury earthquakes and its analysis of the effect of the GFC on our economy. Satish himself thinks of himself as something of a storm chaser. He follows global crises from one to another. And of course, we're currently in another one. Post Satish's presentation, which will take about half an hour, there will be time for questions. And if you can type these into the chat function, and we will run through these once he's finished. Satish, over to you, and welcome and thank you very much.
Thanks, Ruth. Good morning, everyone. As Ruth mentioned, I'm Satish from Westpac's economics team. Thank you for coming to today's presentation, and my thanks to Ruth and the team at the Chamber for helping organise today's event. So this morning, what I'm going to do is take a look at how the economy in Queenstown and around the nation more generally has been tracking. And I'm also going to take a look at some of the big factors that we think are going to shape the economic environment over the next few years. Now, it has been a pretty challenging time for the economy. In areas like Queenstown, with that big exposure to the international border, they have really been at the forefront of those challenges. Now, 2022 is going to be another challenging year, but the nature of those challenges we're wrestling with, it is evolving. We're dealing with a different sort of strain of COVID-19, and the policy backdrop is also changing. So I want to take a look at exactly what that's going to mean for us. So I'm going to flick off my camera now. I'm going to flick over to our presentation. Hopefully that is now up on your screens. Pardon me, hopefully that presentation is now up on your screens. And I thought I'd start off today with a pretty high-level look at the Queenstown economy itself. So up on your screens now, we've got the makeup of Queenstown's economy. And what really stands out to me is that big red segment at the bottom of the chart. That's the employment component of Queenstown's economy that's related to areas like hospitality and recreation. It's about 19% of Queenstown's economy. Now that's about 2 to 3 times the size of what it is in the rest of the country. And that's pretty significant. That's the area of the economy that's really been impacted by social distancing requirements and the closure of the international border. And as a result, the Queenstown economy has had a tougher time with the restrictions that have been in place than other regions. While we have had a large amount of stimulus rolled out through monetary policy, that's lower interest rates, as well as fiscal spending, and that has boosted demand. It hasn't fully offset that drag in the hospitality sector itself. So although economic activity has recovered more generally throughout the country, the recovery in Queenstown has been more moderate. Now, as we look out to the coming year, we are still seeing some ongoing challenges in those customer-facing industries, but we're optimistic that we are going to start to see some changes coming through over the coming year. At the same time, we are seeing firmer conditions in other industries. Construction, which is also a big part of the Queenstown economy, is seeing some solid conditions. There's firm demand in some parts of the household spending area, and we're also seeing firmness in agricultural incomes, which is propagating through the economy more broadly. Put that all together, and we are expecting to see economic conditions firming over 2022, but it's going to continue to be uneven across sectors and across regions. So let's take a look at some of those drivers of economic activity. And I thought I'd start off with Omicron and COVID itself. So up on your screens now, we've got daily case numbers on a per capita basis. And I've put New Zealand at the bottom of the screen there in black. And as a comparison, I've put the Australian experience with Omicron there in red. Now, this latest outbreak is going to have quite a different impact on the economy than the previous outbreaks did. We've now shifted to living with COVID-19 in our communities. And that's quite a big change from our previous elimination approach. Without those lockdowns that we saw in 2020 and 2021, we're not going to see the same big quarter-to-quarter swings in economic output that we did in the past few years. Nevertheless, we still expect to see some pretty significant economic disruptions from this latest outbreak. Now, some of that is because we've still got some social distancing requirements that are in place, but more important than that, I think, is how households and businesses are actually responding to the Omicron outbreak. Even though we can still go out to hospitality venues and the like of that, we are seeing that households and businesses are pretty reluctant to spend. And in the household sector, that's really impacting things like spending in bars and restaurants. Many households are effectively treating this as a mini lockdown. Similarly, in the business sector, businesses are naturally nervous about the economic environment. Plans for spending are on hold in a lot of cases, and that's an important drag on economic activity. The other big area that I'm quite concerned about is what's going to happen to our labour market. What we've seen in other regions is that Omicron does affect large amounts of the labour market. Once we get people plus their household contacts having to self-isolate, it does mean that we see quite high levels of absenteeism. Excuse me. And that is a big concern. And again, in those areas like hospitality, where we are customer facing, but also in areas like healthcare, which is already stretched, and our distribution networks, which are really being quite severely affected right now. That can be a really significant break on economic activity. Now, I think the experience of other economies with Omicron is illustrative here. If we take a look at the Australian experience there in red, well, they had their Omicron outbreak earlier than us, coming through in January. And it did have a pretty material impact on spending in their economy. But what we're seeing with this latest outbreak is that, well, case numbers rise very rapidly. It's about a 5 to 6 week period. New Zealand's already a decent way through that. We're expecting cases to peak in somewhere around the middle of this month. What we saw in Australia was that we did see that very rapid rise, but afterwards, we actually saw cases falling back quite rapidly as well. And as we saw those cases coming down, well, they haven't fallen back to what I describe as low levels, but we did see economic activity coming back very rapidly on the other side. Household spending has actually picked up pretty quickly in Australia as the peak in Omicron cases has passed. And I think that's likely to be what we'll see here in New Zealand as well. But it's still going to be a few more weeks before we hit that peak. And as a result, we are still likely to see some pretty significant disruptions coming through. The other area which is going to be very important for how the economy is affected by Omicron is what happens in terms of our regulation regarding isolation and people coming into the country. So up on the screen now, we've got international visitor arrivals. And you can see that big drop that we saw during the initial outbreak when those isolation requirements came online. And that was an important part of protecting public health in New Zealand. But the environment now is very different. It's a different sort of strain, and case numbers are increasing onshore. Protecting the border is no longer the priority that it was back in 2020. Now, the government is already starting to make some changes on this front. We've seen them announcing a relaxation in the isolation requirements for New Zealanders coming back from Australia. The big one that's going to matter for economic activity on top of that, though, is what happens to the isolation requirements for international tourists. And the government has hinted pretty strongly that the current requirements to isolate for about a week are going to be relaxed. They haven't given a specific date for that. We do need to see when the current case numbers peak, but we do anticipate that probably around the middle of this year, those restrictions are going to be relaxed pretty significantly. And I think that'll be really important for our tourism and hospitality sectors. When those isolation requirements are relaxed, it'll give businesses more certainty. It'll allow for airlines and passengers to start planning ahead. And we anticipate that we'll start to see international visitor numbers climbing from the back part of this year. Now, that will be from a low level. So for a lot of businesses, they'll still be wrestling with subdued demand, but it'll still be quite important for confidence and planning after what's been a tough few years. I think the other thing to keep in mind, especially for the near term though, is that we're not the only economy that has opened up. And so in the near term, it probably will be a more gradual lift, but nonetheless, this is looking like it is going to be quite a change for the international tourist sector in New Zealand. Now, while we have seen those very tough times in those customer facing industries and those industries that are linked directly to the international border, it has been quite a different picture when we look at the more domestically oriented parts of the economy. And I think the best reflection of this is what's been happening in our labour market. I've got Queenstown's unemployment rate up on the screen right now, and it is extremely low right now at 2.7%. And on a nationwide basis, unemployment is at a record low of 3.2%. We are seeing that despite those headwinds that we're wrestling with from COVID, the domestic economy has actually remained pretty resilient. Businesses are still looking to take on labour. They're having a tough time trying to find enough workers to meet the demands that they are seeing. And we've seen that strength in a number of key industries. Construction is the big one. There's a record amount of new homes being consented. In Queenstown alone, there were about 2,300 new dwellings consented over the past year. And across the nation, there is a very large pipeline of work that's likely to mean that construction activity is going to remain elevated for some time. At the same time, we're seeing strong indications in other areas. Outside of hospitality spending, households are actually still hitting the stores or more the online stores and spending up on a range of items. There is actually quite a good level of demands there. And our manufacturers, they're also telling us that order books are looking pretty good. But while we are seeing those positive conditions, there are some big headwinds that many businesses are struggling with. We've got shortages of materials and those disruptions to international supply chains. That's meaning that the delivery times are stretching out pretty considerably. Costs are rising is at a pretty decent pace as well. Staffing as well is a major challenge for many businesses, and that's starting to pass through to higher wage costs. To date, it's mainly been an issue for highly skilled occupations in areas like manufacturing, construction, and IT, but increasingly demands for higher wages are coming through. And I think over the coming year, with a higher inflation environment, we are going to see wage growth picking up pretty materially. And that'll be an important issue for many businesses who are already struggling with pressure on wages. Now, in addition to that strong domestic demand story, what we've also got are strong prices for our key agricultural exports. I've got dairy prices up on the screen. That's the main export, of course, for New Zealand. They're at a record level right now, and we're expecting Fonterra to come through with a record payout of around $9.50 this season. And that's delivering a really powerful boost to incomes in our agricultural communities. And it's flowing out in terms of increased spending through those regions, but it'll be seen in the economy more broadly. And I think that helps to reinforce the uneven nature of the economic cycle we're dealing with right now. I mentioned before that areas like Queenstown, also Nelson, they've been struggling with that lack of international tourism. But when we go through some of those central North Island regions where there are very large agricultural communities and international tourism doesn't play a big role, they've actually seen some very positive economic conditions with that boost to incomes from the farming sector, but also a pickup in domestic tourism, which doesn't offset the loss of international tourist dollars, but for those regional economies, it has played a pretty important role. And so the feeling of the economic cycle, depending on where you are in the country, it is very different right now. Now, if I put all that together and take a look at overall economic activity, that's GDP on your screens right now, you can see how this is all played out. If I look back over the past couple of years, you can see some big spikes associated with the outbreak of COVID-19. And as we've come into 2022, we are wrestling with that latest outbreak of Omicron. Economic activity is looking a bit subdued. But over the coming year, we think that those initial disruptions from Omicron are going to pass. We've still got firmness in other sectors, and eventually the international border restrictions are going to ease. And as a result, we expect that the resilience right now will maintain a feature of the economy, and that we'll start to see economic activity firming as we go through this year. But I still anticipate that it will be uneven across regions and sectors. And I think Queenstown, with that ongoing softness in international tourist arrivals, at least for now, will probably see a more gradual recovery than other regions. But as we look out to the next few years, that's probably going to start to close as international tourists start coming back into the country. Now, while we are seeing some overall firm economic conditions, I mentioned before that we are encountering a number of challenges, and probably one of the most important right now is inflation. I've got consumer price inflation up there on the screen, and you can see the really big spike that's come through over the past few months. Consumer price inflation hit a 30-year high at the end of last year, rising to 5.9% on an annual basis. We think it is going to rise even further in the near term, going above 6%. Now, there are a number of factors that are giving us that really strong consumer price story right now. Some of those are due to offshore factors, including disruptions to international supply networks. And I think that's likely to be a feature of the global economy for some time yet. We're still dealing with disruptions to manufacturing processes overseas. We're also seeing a change in what's happening to supply lines. For the past few years or past few decades, there's been an increasing focus on just-in-time delivery, very efficient supply chains that have helped to keep prices down. But in the wake of COVID-19, there's been a bit of a shift in that thinking. Rather than just in time, the focus is now on just in case, making sure that supply chains are resilient. And that can mean changing where we source things from. It might not be the cheapest, but the security of the supply line is what's more important. And that does mean we are probably looking at a slightly higher cost basis for many of the goods we import. We've also got oil prices that are ramping up very rapidly. They've more than doubled over the past year. We've got the additional pressure in the near term as a result of the conflict in the Ukraine, and that's given a really powerful lift to consumer prices. And households, they're feeling that in the pocket right now. When they go to the pump, it is really draining a lot out of a household's wallets, the disposable income that they can spend in other areas. Now, those are pretty powerful factors, and as I mentioned before, I think they're going to boost inflation for some time yet. But over time, their impact will start to fade. So supply disruptions will ease. Well, we've had very large increases in oil prices. We're probably not going to see another doubling over the coming year. Even so, I think inflation is going to remain elevated for some time. As businesses, we often tend to focus on those cost side pressures for inflation. But what's going on in New Zealand right now, what makes us a bit different from many other regions, is the strength of our demand side pressures for inflation as well. I mentioned before, we are seeing some pretty solid levels of consumer demand right now, and that gives inflation quite a different dynamic. If you think about a strong demand environment, it means businesses have got greater scope to pass on some of those cost increases, especially in areas like construction where we're seeing strong cost increases, but hot demand. There's still that pressure on margins, but there is the ability to pass it on to consumers. It's also very important in the sense that even as cost pressures ease off, if demand is strong, you're likely to see prices continuing to rise at a reasonable pace. You're also likely to see ongoing pressure on wage inflation. And That dynamic is really important for our Reserve Bank and what's happening to interest rates. The Reserve Bank knows that they can't offset big increases in international oil prices that happened 3 months ago. So they try to look through those events. They focus more on those sustained causes of inflation. But strong demand, that is something they cannot look through. It is a big influence on what they do with rates. And importantly, in their current environment, one of the reasons why we have strong demand is because the Reserve Bank cut rates in the wake of the initial outbreak to try and get demand at firm levels. If we take a look at the Reserve Bank's key policy rate, the official cash rate that's on your screen now, it is at very low levels right now. They've raised it 3 times. It's now at 1%, but that's well below what we consider to be a normal level. So it's still providing quite a high degree of stimulus for the economy. But the Reserve Bank is taking its foot off the accelerator, and they have signalled very clearly that they are going to continue removing stimulus over the coming months. Now, we anticipate that the cash rate is going to rise from 1% now to 3% next year. And that's a very material move. It'd not just take out some of the stimulus that they put in place over the past few years in the wake of the outbreak, it'd take interest rates into tight territory, or to put that another way, it'll actually be a level of interest rates that will be dampening demand rather than adding to it. And we're really going to feel that on a number of fronts. For households, the main way they'll see it is in terms of what's happening to mortgage rates, which are already starting to push higher. And that is going to drain quite a considerable amount out of households while it's dampening that spending dynamic. The way that comes through in New Zealand is via the housing market. So up on the screen now, we've got house prices in Otago. And we've seen some very large increases over the past year, or past 2 years, I should say. Since we've seen those big interest rate cuts in the wake of COVID, house prices have risen by about 30% in Otago. Nationwide, we've seen even larger increases, running around 40%, with the biggest gains in some of those central North Island regions. And that's really important. In New Zealand, the housing market plays a big role in shaping economic conditions more generally. It's a big boost to areas like construction, but it also impacts New Zealand's confidence or more general willingness to spend. So when the housing market is going strong, house prices are rising rapidly, we tend to see strong consumer demand as well, and that's 60% of the economy. So this is a very important dynamic for us. Now that interest rates are on the rise, some of that strength in the housing market, it has started to dissipate. You can see what's happened to house price growth in Otago. In annual terms, it's dropped back down from rates of close to 30% to something more like 15%. That's still a pretty decent rate of growth, but when we dig into the details, there's really been quite a significant step down in the last few months alone. Prices have fallen by about 2% since November. And that might not sound like a big change, but the direction of play for the housing market is really looking like it is moving to the downside. Not only have house prices eased off in the last few months, sales have dropped pretty considerably. They're now below pre-pandemic levels. Applications for mortgages have eased off, and we've also seen a tightening in lending conditions. All of that combined with those those increases in interest rates, it does point to a further cooling in the housing market over the coming year. And we're anticipating that after that recent 2% drop, we're probably going to see prices ease by about another 5% this year, perhaps by the same extent next year. Now, that's quite an unusual dynamic for the New Zealand economy, actually seeing prices drop, but we have seen it before. And it's also important to put it in context. We've had a period of several years now with interest rates at very stimulatory levels. We're now moving to the other side of that, where interest rates are going to be contractionary. So that big boost that the housing market's enjoyed for the past couple of years, it is going to go into reverse. And we're seeing the initial stages of that now. But what does that sort of mean? Well, what does a 5% drop in house prices mean? For a lot of households, chances are you're not selling your home every year. So even if you're looking to sell your house over the coming few months, you're probably looking at quite a significant capital gain. If you're looking to enter the housing market, we're only looking at prices coming back to where they were in the middle of last year. So that is still quite a stretched level of affordability. So I think it'll still be a big challenge for many households looking to get into the economy. But this is still a very important dynamic with a softer outlook for the housing market that is likely to ripple through households' willingness to spend more generally. It's likely to affect confidence. So I think this will be very important for shaping economic conditions. Now, just before I wrap up, I did want to touch on the situation in the Ukraine. Now, this is obviously a very worrying humanitarian issue, and there is going to be an incalculable human cost to this event. There will be some economic impacts as well. Here in New Zealand, the direct exposure of our economy to the Ukraine and Russia, it's actually fairly limited. They're not large trading partners for us. We do send some dairy products over them, but it's a relatively small share. Nevertheless, we are exposed to this conflict through other more indirect channels. Probably the key way that we're exposed is what's going to happen to commodity prices. We've already seen some big impacts on oil prices. The price for a barrel of oil is now over $100. And we are going to feel that at the pump in terms of higher prices when we go to fill up the car. This is also going to be a big impact on the price of food products, particularly grain. And that then ripples through other markets like dairy and other agricultural products due to the impact on feed costs. Now, for New Zealand, that's probably going to reinforce what is actually some quite strong prices, but it could impact farm profitability. The other channel where we're exposed, which is more opaque, is what's going to happen in financial markets. We've seen a lot of volatility in financial markets since the start of this year, and the uncertainty around this event is really going to add to that, as well as those big swings we've been seeing in equity markets. And some of you may have also heard about financial sanctions on Russia, including excluding them from the global SWIFT payments network. That's the network that banks use for the transfer of funds. Now, that's one that I'm really not sure about exactly how it is going to affect us, but there is some concern about if Russia can't make payments or if other countries are facing higher costs of interacting with Russia for their energy, well, that could cause disruptions or frictions in global financial networks, and that could reinforce some of the softness in the global economy, potentially adding to interest rate pressure. It's an evolving situation. As I mentioned before, it's really a humanitarian situation, but we will need to keep an eye on some of those economic consequences as well. So that's all I was going to say on the economic outlook. It is still quite an uneven outlook for the economy for the next few years, but we are seeing that firmness coming through, and we're optimistic that we will start to see areas like tourism seeing better conditions over the next few years. Now, for Otago and Queenstown, it does mean that the recovery, at least in the near term, is likely to be a bit more gradual than other regions. But as I look out to the next few years, I expect that is going to start to firm as the borders reopen, and we're still getting that boost from other areas. So it will be quite an interesting few years. So thank you for your time. Happy to talk about those issues or any other questions that people had.
Thanks very much, Satish. So everyone, if you have any questions, please do put them into the chat function. So Satish, just following up on your comments about the Ukraine, the Reserve Bank of Australia held rates this week given that global situation, and your forecast for rising interest rates saw them happen reasonably quickly. Do you think that there will be any extension in time now with the RBNZ reflecting on the RBA's move and the uncertainty?
I think ultimately what's going to drive domestic interest rates are domestic conditions. So the RBA has responded to a different inflation picture than what we're seeing. Their inflation story hasn't been as pronounced, while ours is pretty severe. Now, when the Reserve Bank was out last week, they increased interest rates by 25 basis points, but they did highlight the risk that they could go in bigger steps, 50 basis points. Now, personally, I think that's less likely. I think we are still facing some big headwinds, particularly from Omicron, but that uncertainty around the global situation and the conflict from the Ukraine, I think that'll reinforce what is more likely to be a gradual tightening in policy rates, but it is still, the direction of play is likely to be to the upside for some time yet. Your
forecasts indicated that we're going to return to pre-COVID levels in terms of our international visitor numbers by about 2025. What are your thoughts on if and how our visitor mix will change?
It's going to be quite an interesting story. I mean, whether we see a mix from sort of more casual tourists or lower value tourists, particularly from Australia, and I expect that'll continue to be a very significant market for us just because of the geographic proximity of Australia. But I think we'll likely see a push to bring back those higher spend markets like China and the US. I think the complicating factor there is what's happening in terms of our concerns around environmental sustainability and the numbers that we're bringing in. Of course, air travel, moving around borders, these are big issues for our environmental commitments, and that's going to be a tough one for us to manage. There'll be a balancing act to strike about whether we want to bring in fewer numbers that are higher value, or if we want to focus on effectively a larger number of tourists. And it's quite a tough one to see how we are going to manage this. Much of this will also depend on what happens to international appetites for travel in some of those big regions as well. Of course, we've all been dealing with those uncertainties around COVID and safety, and I'm a little concerned about whether those higher spend markets will want to make the trip down to this part of the world in the very near term, given the ongoing concerns.
The supply constraints, labour constraints and interest rates increasing aren't really great news for small businesses. And obviously we are an area that has a rather high concentration of small businesses. What's your advice to them on managing in the near to medium term?
It is going to be a pretty tough story. I mean, what we've been hearing from all businesses essentially is that working capital is the big issue that they are wrestling with right now. Many of those small businesses, supply chain disruptions are resulting in a lot of challenges, as well as rising costs. Sometimes we're being faced with having to keep greater levels of stock. Just if we can get it in, they bring it in larger amounts to ensure that they have got the supply there, but the storage issue is creating pressure on their working capital. My advice there, and it's not just because I work from a bank, is it is a good idea to have a chat to whoever your financial provider is to just check that those facilities are in place. A lot of businesses are going to be wrestling with short-term pain, and having those facilities that are in place to allow you to continue operating, it's going to be very important as we continue to work through what is likely to be a protracted period of disruption.
Those interest rate increases and house prices with a downward pressure and inflation in household costs is going to particularly affect those people who have recently entered the market. What's your view on the impact on those people and how it will affect our first home buyer market? For instance, our local banks are reporting many of our first home buyers are relying on the bank of mum and dad to get into their first home.
Yeah, it's been a very tough time. I mean, it's been a tough time to be as a first-time buyer for an extended period, but prices have risen by a pretty significant extent now, and there is a greater focus on ensuring that that debt is serviceable. Now, for a lot of home buyers right now, particularly in areas like Queenstown, also Auckland, where prices have risen by a pretty significant extent, those hurdles for saving for a deposit, they are pretty tough. So it's going to be quite a lot of sacrifices for many households. If you want to get into the market, we are going to have to save quite a lot, and it's going to require some pretty careful judgment in terms of what you do in terms of your employment situation and more generally what you spend. If you're in the market now and you are looking at those interest rate increases, well, we are still looking at what are currently fairly low interest rates. So the amount of household income that's being spent on debt servicing, it is actually fairly low right now. That is going to creep higher over the next few years, and that'll squeeze household budgets. But compared to what we've seen over the past few decades, even with the interest rate increases we've got coming through, it's likely to see debt servicing remaining a relatively low share of household incomes. So we're hopeful that if we can get inflation under control and that we can keep the economy on a sustainable course, those interest rate increases will be a dampening impact on those first home buyers, but not to the extent that it will cause significant pain, probably more a period of belt tightening for a period rather than a big downturn.
We've talked about personal home interest rates. What's your view on where business lending rates are and will be going in the near future?
Well, our general expectation for interest rates is going to be to the upside right now. We have seen, and that is coming through mainly from what's happening with those policy interest rates from central banks. And right now, as I mentioned before, they have been very low. Just as the mortgage rate is pushing higher as the central bank raises interest rates, those costs for businesses are likely to increase as well.
What are you hearing, or what is your experience with general business debt levels at the moment?
I think businesses have been very mindful about how much debt they are going to take on right now. Through the last few years, where there's been that big uncertainty about where the economic environment is going to go, businesses have been cautious about new spending, capital expenditure in particular, and paying down debt. And the low interest rate environment has made that a great time to reduce those debt levels. So I think that has put us in a better position as we come out of this. Households coming, depending on which business you're in, your balance sheet could be in a better shape. It's not just manufacturing or businesses like that. We're also seeing it coming through in our agri sector, which is very important for the overall size of the New Zealand economy. We know that they are definitely taking advantage of high prices right now, good returns, and low interest rates to pay down debt.
What have your observations been in terms of the diversification of New Zealand's economy, if at all, particularly over the last couple of years, and the direction for that?
It's a big issue for us, and it's often highlighted as one issue that could be affecting our longer term growth. In terms of how diversified our economy is, we are pretty heavily concentrated in areas like agriculture. Also, construction plays a very significant role onshore. It's a very tough one for us. I obviously think about diversification as a way to make the economy more resilient or being able to adapt. But we are hamstrung to a degree by our location. Essentially, we are trying to keep the economy. Oh, pardon me. Sorry. Essentially, we are trying to keep our economy growing, but because we are so far away from the world, if we want to develop new industries, we've got a fairly limited market. It's not like being in Europe or Asia, where you've got a very, very large markets right next door. We are really looking at a very small market just on our doors, or maybe over to Australia. So if we want to develop, it's quite a tough sell in order to get the scale that you need to develop. So diversification is going to be important for us, but it's going to be tough to get that underway. But we're seeing big advances now with the growing use of remote working, the greater use of technology. It is helping us diversify, and we are going to see increasing changes over time, but I think New Zealand will still face some challenges over the coming years.
If New Zealand was to have a change in government next year, how, if at all, would that impact your forecasts?
It's an interesting question. I can't predict elections. I think that's actually quite an interesting point. One of the big factors that has underpinned our economic performance over the past couple of years has been that we've had significant increases in government spending. And during the pandemic, when we were facing some really significant impacts on economic activity, dialing up that spending to keep the economy going, I think that was a good decision. But we're now in another phase of the pandemic. Government debt levels are high, and we are potentially going to have to see some rationalization in terms of our spending to keep debt on a stable, government debts on a stable course. Well, we'll have to consider, where do we want to spend, or how much do we want to spend in areas like education and health. Also, how do we want to fund that? Chances are we're going to have to see some restraint in spending to keep debt levels on a solid track. Now, that's exactly how that plays out. It is a political decision. We've seen left of centre governments do tend to spend up in those areas. It's where their decisions lie. Right of centre governments, they tend to be a little more cautious in terms of that public spending. I think that would be the big area where we could see things coming through. If we saw a change, there's likely to be a little more restraint. Now, depending on your political views, that can be a good or a bad thing. We could get ongoing spending in those essential services, which is great. But again, we do need to keep those debt levels under control. And if we're increasing spending in the public sector, it can crowd out the amount that we can spend in terms of the private sector due to increases in funding costs, as well as that pressure in the labour market. So it's a challenging decision for us as an economy to make, and it's one that we will have to confront over the coming years.
Just one last ask for questions. If anybody has a question, please put it in the chat. Satish, immigration policy. What is your view on how the government's current approach to immigration policy is underpinning the economy's performance going forward? And what, in your view, do you think needs to change?
I think immigration is going to be it's going to come back onto the radar as a pretty big issue. Before the outbreak, we had high levels of immigration, around 50 to 60,000 people coming in per annum. That provided a big boost to the economy in a couple of ways. It added to our labour market. It also added to demand for goods and services, housing as well. But it also added to our supply capacity. When we talk to businesses across the country, getting in those essential skills, it's tough in a small market like New Zealand. We do need to rely on international markets. And of course, our young people, they travel, they develop their skills abroad. On the other side of this pandemic, I think the migration picture is going to be very different. Even before COVID-19, the government talked about tightening up migration settings, bringing down that high level of inflows and focusing more on skilled labour. We expect that is now what they are going to do. They've got the political capital to do it. They've got the timing to do it in terms of the borders starting to reopen. So instead of those levels of about 50 to 60,000 people a year, we expect that migration's probably going to run at rates of closer to 30,000 on the other side of this current crisis. That's a pretty material change. It'll mean fewer bodies coming into the country. So if you're a consumer-facing business like hospitality or supermarkets, it's slower growth in your demand base every year. If your business is more generally, well, if you're trying to source those skills from abroad, I think that will be tougher. And this does raise a number of issues for us domestically. It's great that we want to develop skills onshore. That's why the government is changing that policy to encourage people and businesses to develop skills in our local workforce. But it takes a long time to do that. And it's also hard to retain those skills. Young New Zealanders with in-demand skills, they do tend to be mobile across businesses, but across geographic regions as well. So I think this is going to be a pretty challenging issue for us to confront over the next few years.
And last but not least, a lot of us have seen our KiwiSaver take a bath in the last year. What would be your advice on where it should be put?
Westpac. Put it with Westpac.
Right. Thank you very much for your time, Satish. Thanks everybody for joining us this morning. The webinar has been recorded and will be up on our website. I hope you have enjoyed this, and hopefully our next seminar series we can have in person. And Satish, we can get you to Queenstown and you can help support our local economy.
Thank you. It would be my pleasure to get down there and see you all in person.
Thanks everyone. Have a great day.